Hey, before we jump in, just a real quick but super important heads up. Everything we're talking about today is for educational purposes only. It is definitely not investment advice, so please make sure you chat with a financial professional before making any decisions.
Have you ever looked at a stock quote and just felt like you were trying to read a totally different language? With all those numbers and acronyms, it can be a bit much. But what if I told you there's a simple decoder ring, a set of tools that helps you find the actual story hidden behind all those numbers? Well, that's exactly what we're going to do today. We're going to build that toolkit together.
So think of financial ratios like a quick health check for a company. Like when you go to the doctor for a checkup. They're not going to reveal absolutely everything, but they offer a really vital first impression of a company's financial well-being.
Ultimately, what it all boils down to is this one key question. Is this stock a potential bargain, or is it an overpriced risk? These ratios act as your first filter, helping you quickly spot the good stuff and the red flags, so you can move forward with a lot more clarity and confidence.
All right, so here's our game plan. We're going to start by decoding three of the most common metrics out there: the PE ratio, the PB ratio, and the dividend yield. Then, and this is super important, we're going to have a reality check about why these numbers can sometimes mislead you. And finally, we'll pull it all together into a practical toolkit you can actually start using.
Okay, let's kick things off with the big one, the price-to-earnings ratio, or PE. This is the metric you'll see pretty much everywhere, and for good reason. You can think of it as a barometer for how the market is feeling. It tells us just how optimistic or pessimistic investors are about a company's future.
So how does it work? It's actually pretty simple. The PE ratio is just the stock's market price divided by its earnings per share. And earnings per share is just the company's total profit divided by all its shares. So, in plain English, the PE ratio tells you exactly how much investors are willing to pay for one single dollar of a company's profit. So if a stock has a PE of 20, it means investors are forking over $20 for every $1 of earnings. So does that mean a high PE is good and a low PE is a bargain? Well, it's not that simple. A high PE usually means investors are really excited. They're expecting huge growth and they're willing to pay a premium for it. On the other hand, a low PE, well, it could be a sign of an undervalued gem. Or, and here's the catch, it could be a warning that there are some problems hiding under the hood.
And this is why context is absolutely everything. PE ratios are not one size fits all. What's considered a high PE in, say, the healthcare industry might be seen as pretty low in the tech world. So the key takeaway here is crucial. A PE ratio is only meaningful when you compare it to other companies in the exact same industry. You can't compare apples to oranges.
Okay, so the PE ratio tells us what the market thinks about a company's future earnings. But what about the actual stuff a company owns right now? That's where our next tool comes in handy, the price-to-book ratio, or PB. This one shifts our focus from profits to assets.
The PB ratio compares a stock's price to what's called its book value. The easiest way to think about book value is to imagine the company had a giant going-out-of-business sale. They sell everything they own, all the buildings, all the equipment, and then they pay off all their debts. The cash that's left over, that's the book value.
And this brings us to a core idea that value investors absolutely love. If you find a stock with the P/B ratio below 1, it suggests you could be buying the company for less than its physical assets are even worth. It's kind of like buying a dollar's worth of stuff for just 80 cents. It's a classic sign that you might be looking at a bargain.
But, and this is a huge but, there's a critical catch. The PB ratio works best for companies with lots of tangible stuff you can touch, like factories and machinery. It's way less useful for a modern tech company where the real value isn't physical at all. It's in things like software code, patents, or a super powerful brand name, stuff that often doesn't even show up on the official balance sheet.
All right, our first two ratios were all about a stock's potential value. But what if a stock could just pay you cash for owning it? Well, it can, and that's where our third tool comes in, the dividend yield. This one's all about the cash you can get back as an investor.
The dividend yield formula is really straightforward. It's just the annual dividend a company pays per share divided by that share's current stock price. That percentage tells you exactly what kind of return you're getting back in cold, hard cash each year just for being a shareholder.
So you might see a high yield, maybe over 4%, and think, wow, that's tempting. But you got to be careful. Sometimes the yield is high because the stock price has totally tanked for a very good reason. We call this a yield trap. So how do you check if that dividend is safe? Look at the company's payout ratio. If a company is paying out more than 100% of its profits as dividends, that is a massive red flag. It's just not sustainable. It's like paying your bills with a credit card because your paycheck ran out.
And look, dividends aren't just some abstract idea. We're talking about massive amounts of real cash. Some of the biggest companies in the world, like Microsoft and Apple, pay out tens of billions of dollars to their shareholders every single year. It's a very powerful, very tangible return on your investment.
Okay, so we've armed ourselves with some pretty powerful tools. We're feeling good. But now it's time for that crucial reality check, because sometimes these ratios, well, they can lie.
So you're probably thinking, okay, I get it. A low PE ratio means it's a bargain, right? Well, not so fast. This is the classic value trap. A stock can be cheap for a very good reason, because its business is fundamentally broken and just isn't getting any better. Here's the truth every smart investor needs to understand. These ratios have serious limitations. For one, they only show you the past, not the future. They tell you nothing about the quality of a company's leadership or how strong its brand is. And yeah, they can even be manipulated with some clever accounting. The bottom line is this. Ratios are a fantastic starting point for your research, but they should never, ever be the finish line.
So how do we use these tools without falling into those traps? Well, it's all about putting them together and building a smarter valuation toolkit.
Here are 3 simple but incredibly powerful rules. 1, never rely on just a single ratio. You have to use them together to get a more complete picture. 2, always, and I mean always, compare a company to its direct competitors in the same industry. And 3, look at the trend over several years, not just a single snapshot in time. A single year can be a fluke. A trend tells a story.
So let's end with this. Financial ratios tell a crucial part of a company's story. They're not the whole story, of course, but when you use them the right way, they are your best tool for cutting through all the market noise. They empower you to make decisions based on substance, not just on